Something leaked from the Federal Reserve building. They don't want you to see it. Ladies and gentlemen, Asian guy here, and what I'm about to reveal will fundamentally change everything you thought you knew about monetary policy, banking stability, and the real reason behind Jerome Powell's desperate rate cuts over the past 6 months. While mainstream media celebrates employment numbers and inflation data, while Wall Street analysts praise the Fed's measured approach to economic management, while politicians debate fiscal responsibility, the most dangerous financial crisis in modern American history is unfolding behind the marble walls of the Mariner Eccles Federal Reserve Building in Washington, D.C. This isn't about employment. This isn't about inflation. This isn't about economic growth or recession management. This is about survival. Because 16 hours before you're watching this video, something unprecedented happened. A source inside the Federal Reserve Bank of New York, someone with access to the most classified monetary operations in the global financial system, contacted me with information that explains everything. Why Powell cut rates 3 consecutive times despite inflation running hot. Why the Fed quietly restarted quantitative easing without calling it quantitative easing. Why emergency lending facilities are operating at levels not seen since 2008. The silver crisis is real, it's systemic, and it's about to destroy the banking system that underpins the entire American economy. But before I reveal what my source told me, before I show you the leaked documents that prove major banks are hemorrhaging billions in silver derivatives losses, before I explain why Jerome Powell has exactly 96 days left to prevent a monetary catastrophe that would make 2008 look like a market correction, you need to understand something that will shock you to your core. The December Federal Open Market Committee meeting wasn't really about monetary policy. It was an emergency session to prevent the immediate collapse of multiple systemically important financial institutions. My source, and I will obviously protect their identity with my life, works in the Market Operations Division of the Federal Reserve Bank of New York. This is the department that handles repo operations, discount window lending, and coordination with the 24 primary dealers who make markets in government securities. This person has been watching stress signals build in precious metals markets for 8 months. They have been reporting to their superiors about growing correlations between silver price volatility and banking sector liquidity strains. And according to this source, every single Federal Reserve policy decision since June has been designed around one singular objective: preventing a derivatives-induced banking collapse with silver futures contracts at its epicenter. Let me read you the exact words that were shared with me, words that will haunt the financial system for decades to come. The governors are terrified. They're seeing stress indicators in the silver market that remind them of the nickel crisis on the London Metal Exchange, but amplified across the entire American banking system. They know that if the arbitrage relationship between COMEX and Shanghai silver prices breaks permanently, it could cascade through interest rate swap markets, currency derivatives markets, and credit default swap markets simultaneously. They're not cutting rates to stimulate economic growth. They're cutting rates to provide emergency liquidity to banks that are burning through capital, trying to maintain short positions in a market that has fundamentally shifted against them. This changes everything we thought we understood about Federal Reserve policy over the past year. But that revelation is just the beginning, because what my source revealed next exposes the true scope of this crisis and why Jerome Powell's remaining 96 days as Federal Reserve Chairman may determine whether America has a banking system or a banking catastrophe. While public attention focused on the Fed's published stress tests, the annual examinations designed to demonstrate banking system resilience, my source revealed that the Federal Reserve has been conducting classified stress tests, specifically modeling extreme commodity price movements since August. These aren't the sanitized scenarios presented to Congress and the media. These are worst-case simulations that model what happens to major bank balance sheets when paper silver markets collide with physical silver scarcity. The results, according to my source, are catastrophic beyond anything the Federal Reserve has ever documented. The stress test model 3 scenarios. Scenario 1 assumes silver reaches $100 per ounce by the end of March, less than 90 days from now. Under this scenario, 3 of the 8 globally systemically important banks operating in the United States would be technically insolvent. Their silver-related derivatives losses would exceed their Tier 1 capital requirements, but Scenario 1 is the optimistic case. Scenario 2 models: what happens if COMEX silver markets suffer a force majeure event, a situation where physical delivery becomes impossible and contracts must be settled at distressed prices. In this scenario, silver prices could theoretically reach any level: $200, $300, $500 per ounce. There is no mathematical upper limit when paper abundance meets physical scarcity in markets where industrial demand cannot be postponed or substituted. Under Scenario 2, my source tells me, the entire United States banking system would be insolvent. Not 3 banks, not 5 banks, all of them. This is why Federal Reserve governors meet in emergency sessions every weekend. This is why discount window lending has reached levels not disclosed in public Federal Reserve statistics. This is why the $40 billion Treasury purchase program launched last Friday without the usual congressional notification procedures. They're not managing monetary policy. They're managing a systemic collapse in slow motion. But here's what makes this crisis truly unprecedented. Here's what my source says keeps Jerome Powell awake every night during his final months as chairman. The major banks aren't just holding paper positions in silver derivatives. They have contractual obligations to deliver physical metal that doesn't exist in quantities sufficient to meet their promises. When Goldman Sachs sells a silver futures contract, they're promising to deliver 5,000 ounces of actual silver at a specific date. When JPMorgan Chase writes silver options, they're guaranteeing physical delivery if those options are exercised. When Deutsche Bank engages in silver swaps, they're committing to provide real metal to counterparties who increasingly demand physical settlement rather than cash payment. According to my source, Goldman Sachs alone is short approximately 400 million ounces of silver through various derivatives instruments. 400 million ounces that they would need to purchase in physical markets if their counterparties demand delivery. 400 million ounces that represents more than half of total annual global mine production. JPMorgan Chase, despite accumulating what industry sources suggest may be the largest private silver hoard in history, simultaneously maintains massive short positions in paper markets. The bank has been playing both sides of the trade, accumulating physical metal while shorting paper contracts to suppress prices and make their physical accumulation cheaper. But other major institutions followed JP Morgan's paper shorting strategy without building corresponding physical positions. These banks thought they were trading financial instruments that could be settled in cash like most derivatives. They didn't understand that silver is different. Silver is simultaneously a financial asset and an industrial commodity. When industrial demand exceeds mine supply, cash settlement becomes impossible because buyers need the physical metal for manufacturing processes that cannot be postponed. Tesla needs silver for electric vehicle production. Samsung requires silver for semiconductor manufacturing. Every solar panel installation across America and Europe depends on silver paste for photovoltaic cell functionality. This industrial demand isn't discretionary. It's not price sensitive. It's existential to business models that power the modern economy. This context explains what really happened during the December Federal Open Market Committee meeting. The meeting that resulted in a 9-3 vote for another rate cut despite inflation running above target. The meeting that launched quantitative easing without calling it quantitative easing. According to my source, the meeting began with a presentation from New York Fed staff about stress indicators in commodity markets, specifically about the persistent premium between Shanghai silver prices and COMEX silver prices, about record delivery demands against COMEX contracts, about unprecedented withdrawals from registered warehouse stocks, about growing difficulty that primary dealers face sourcing physical metal to satisfy institutional client demand. The staff explained to FOMC members that several systemically important banks have what they delicately termed concentrated exposures in precious metals markets. In Federal Reserve speak, concentrated exposures means massive naked short positions that are underwater and growing more expensive every day. These banks have been using Treasury securities and agency mortgage securities as collateral to borrow money from the Fed through discount window facilities and repo operations. Money they then use to post margin on losing silver trades, money they desperately deploy attempting to source physical silver from dealers, refiners, and secondary markets at prices well above paper futures quotations. But here's the revelation that should terrify every American with money in the banking system. The strategy isn't working. Banks are burning through liquidity faster than the Federal Reserve can provide it. The silver shortage is accelerating rather than moderating, and industrial demand continues growing while mine supply remains constrained by geological reality that no amount of financial engineering can overcome. Kansas City Fed President Jeffrey Schmid, who voted against the December rate cut, reportedly stood during the discussion and delivered what my source described as the most direct challenge to Federal Reserve crisis management in decades. "We are not central planners. We are not commodity managers. Our mandate is price stability and full employment, not bailing out banks that made speculative bets against industrial reality. If JPMorgan Chase or Goldman Sachs wants to short silver during a supply crisis, let them face market consequences." Schmid was overruled. Jerome Powell, according to my source, explained to committee members that the silver crisis cannot be viewed in isolation. The interconnectedness of modern financial markets means that derivative failures in commodity spaces immediately transmit to interest rate derivatives, currency derivatives, and credit derivatives. Powell told the committee they faced a choice between allowing market forces to operate and preventing systemic collapse that could exceed 2008 in scope and severity. They chose intervention. They chose to sacrifice monetary policy integrity to protect institutions that have manipulated silver prices for decades. But there's a geopolitical dimension to this crisis that makes resolution almost impossible. A dimension that my source says represents the most sophisticated economic warfare campaign in modern history. While American banks were building massive short positions in paper-silver markets, while they were promising to deliver metal they didn't own to customers they couldn't satisfy, China was systematically capturing every critical link in the global silver supply chain. This wasn't random commercial activity. This was coordinated state policy implemented over 15 years with strategic precision that makes American financial engineering look amateur. Beginning in 2018, Chinese mining conglomerates acquired controlling stakes in Chilean operations producing 7.2 million ounces annually. 6 months later, they purchased Peruvian assets adding 11.4 million ounces. In 2019, China non-ferrous metal mining acquired Mexican operations contributing 18.7 million ounces to their growing portfolio. But mine acquisition was just the foundation. The strategic genius was capturing refining capacity and transportation networks. By 2022, Chinese entities controlled 127 million ounces of annual silver production and 67% of Western Hemisphere refining capacity. More importantly, they controlled existing supply contracts to Western manufacturers. When these contracts reached expiration, they weren't renewed. Tesla's Peruvian supply agreements ended with notices that market conditions have changed. Samsung's refining contracts were offered renewal at 340% higher prices. Apple's transportation agreements expired without acceptable replacement terms. China executed systematic strangulation of Western silver access while maintaining perfect legal compliance. No embargoes, no sanctions, just quiet contract expirations that wouldn't be renewed under any terms acceptable to American corporations. This is why Apple's midnight raid through Swiss vaults, paying 500% premiums for metal normally purchased at modest markups, represents desperation rather than strategic planning. While Apple paid $811 per ounce in Zurich emergency purchases, Chinese companies sourced identical metal from their South American operations for $23 per ounce. America is fighting a resource war with financial weapons. China is fighting with actual resources. Jerome Powell has exactly 96 days remaining as Federal Reserve Chairman, 96 days before his successor inherits a crisis that has been building for decades and may be approaching mathematical resolution. According to my source, Powell understands that his historical legacy will be defined not by inflation management or employment statistics, but by whether he can prevent a silver-induced banking collapse during his final months in office. The irony is devastating. Every Federal Reserve intervention designed to prevent this crisis makes it worse. Every rate cut makes dollar-denominated assets less attractive relative to real assets. Every quantitative easing operation devalues the currency and makes precious metals more compelling as stores of value. Every emergency lending facility signals to global markets that the American financial system is more fragile than officials admit. They're attempting to solve a supply problem with demand-side solutions. They're trying to fix physical shortages with financial engineering. They're attempting to bail out derivative contracts with printed money. And according to my source, it's not working. The silver position of the American banking system collectively is now so large and so underwater that it represents an existential threat to dollar stability itself. If major banks are forced to cover their short positions at current physical prices, it would require printing money in quantities that could trigger currency crisis. This creates an impossible strategic dilemma. If the Federal Reserve allows banks to fail, the financial system collapses. If they bail out the banks, the currency potentially collapses. If they attempt to suppress silver prices, they collide with industrial demand that cannot be denied. If they allow silver prices to rise naturally, they bankrupt their own member institutions. There is no elegant solution. There is no policy tool that resolves this crisis without massive economic disruption. My source provided specific intelligence about when this crisis transitions from managed emergency to public catastrophe, when Federal Reserve officials will be forced to abandon carefully neutral language and acknowledge what's really happening behind their marble facades. According to internal Federal Reserve projections, they can maintain current crisis management through February. They can continue providing emergency lending through discount windows and repo facilities. They can continue purchasing Treasury securities to provide liquidity for institutions using government bonds as collateral for silver-related margin calls. But by early March, the stress becomes too severe to disguise. By March, silver shortages become so acute and banking sector losses become so large that emergency measures will be required. Emergency measures that cannot be disguised as routine monetary policy operations. March is when the American public discovers what financial insiders already understand. March is when the silver crisis becomes a silver panic. March is when paper assets begin final capitulation to physical reality. My source expects that by March, Jerome Powell will be forced to conduct emergency press conferences announcing unprecedented interventions, revealing the true scope of the crisis he has been managing in secret for 8 months, admitting that major American banks are insolvent based on derivatives positions in markets they thought they could manipulate indefinitely, and by then, it will be too late for most Americans to protect themselves appropriately. But I haven't told you about the most damning evidence yet. The documents my source provided that prove this crisis extends far beyond what any of us imagined. Federal Reserve internal communications recovered through my source's access show that central bank officials have been coordinating with the European Central Bank, Bank of Japan, and Bank for International Settlements to prevent this crisis from contaminating global markets. The Bank for International Settlements, the central bank of central banks, has been hosting emergency video conferences every weekend for 6 weeks to coordinate global responses to American banking silver exposure. These meetings aren't publicly disclosed. They don't appear on official calendars. But they're happening because global central banking leadership understands that American silver derivatives failures would immediately destroy European and Asian financial institutions with similar exposures. European banks participate in London Bullion Market Association silver trading. Japanese institutions engage in Shanghai Futures Exchange arbitrage strategies. Swiss banks provide financing for precious metals carry trades that depend on stable COMEX pricing relationships. If American silver markets break, global silver markets break. If global silver markets break, the entire post-Bretton Woods monetary system faces existential crisis. The numbers make resolution impossible through conventional policy tools. Global available silver supply, metal not already contracted to industrial users, jewelry manufacturers, or investment funds, amounts to approximately 50 million ounces annually. American banking silver requirements, if forced to cover short positions at current prices, exceed 245 million ounces. Tesla automotive production requires 0.8% of available global supply. Samsung semiconductor manufacturing needs 0.3%. Microsoft data center construction requires 0.2%. Defense contractors demand 1.7% for military applications. Chinese manufacturers have already contracted for 2.1%. Technology companies building AI-powered devices need 7.3% of available silver supply collectively. The remaining 92.7% serves jewelry, traditional electronics, and investment demand. But jewelry manufacturers can be priced out. Electronics companies can delay production. Investors can substitute alternatives. Banks with derivative obligations cannot. They either source the silver they promise to deliver, or they default on contractual commitments to counterparties who increasingly demand physical settlement rather than cash payment. This creates mathematical impossibility disguised as financial complexity. By current trajectories, industrial silver demand will exceed available supply regardless of price. Either silver prices rise to levels that destroy consumer electronics affordability, or technology companies abandon AI development strategies that require silver-intensive manufacturing processes. Neither outcome is acceptable to economic policymakers or political leadership. My source revealed one final piece of intelligence that demonstrates how seriously Federal Reserve leadership takes this crisis. Powell has established a classified silver market stability task force comprising senior officials from the New York Fed's Market Operations Division, Treasury Department's Financial Stability Oversight Council, and Federal Deposit Insurance Corporation's Resolution Planning Department. This task force meets daily at 6 a.m. Eastern Standard Time via secure video conference to monitor silver market conditions, banking sector stress indicators, and contingency planning for potential force majeure events in COMEX derivatives markets. The task force has developed 3 escalating response protocols. Protocol Alpha involves coordinated central bank intervention to provide emergency liquidity for silver-related margin calls. This protocol has been active since October. Protocol Beta involves temporary suspension of silver derivatives trading combined with mandatory cash settlement of outstanding contracts at administratively determined prices. Preparation for Protocol Beta began in December. Protocol Charlie involves federal government takeover of systemically important banks facing insolvency due to silver derivatives losses. Protocol Charlie planning is ongoing. None of these protocols has ever been tested. None has legal precedent. None guarantees successful crisis resolution. Tomorrow's Federal Reserve minutes will not explicitly acknowledge any of this. They will not admit that major American banks are insolvent based on silver positions. They will not reveal that monetary policy has been subordinated to crisis management for 8 months. Instead, they will use careful language designed to signal danger without admitting catastrophe. Watch for references to operational resilience in financial markets. Watch for discussions about diversified funding sources for banking institutions. Watch for mentions of coordination with international regulatory authorities. These are warning signals. These are breadcrumbs leading to truth about what's happening behind scenes that most Americans cannot access. Watch for what's missing from tomorrow's minutes. Watch for absent discussion of commodity market regulation. Watch for lack of silver-specific references. Watch for careful avoidance of physical settlement discussion in derivatives contexts. The Federal Reserve cannot acknowledge the silver crisis publicly, because doing so would immediately trigger the bank runs they're desperately trying to prevent. But for those who understand central bank language, tomorrow's minutes will be a confession that Powell has lost control, a confession that the banking system is more fragile than anyone realizes, a confession that the silver crisis is real and about to reshape American monetary reality. 72 hours until China's silver export restrictions take full effect. 16 hours until Fed minutes release. 96 days until Powell's chairmanship ends. The countdown has begun. The endgame is here. My source's final message. Tell your audience that the transition from paper money to real money has already started. It's not a future possibility. It's a present reality. The archives never lie about how these crises end. The silver squeeze is here. The banking system is trapped. Jerome Powell has lost control. And in 96 days, his successor inherits this crisis completely. This is Asian Guy documenting the moment when infinite paper promises meet finite physical reality. The moment when America discovers that you can print dollars, but you cannot print silver. The greatest monetary crisis in American history is unfolding in real time. The question is whether you'll be prepared when the vaults finally empty and the promises finally break. The countdown continues. The crisis accelerates. And somewhere in Washington, D.C., empty conference rooms serve as monuments to the day American central banking discovered that geology always defeats financial engineering. The silver crisis is real. The banking panic is inevitable. The monetary reset has begun. 96 days and counting.